Transform all your company's milestones, big or small, into impact with Impact Hero. Whether it's a sale, a new hire, a demo booked, or anything else, with Impact Hero, you automatically generate a gift that matters, like a tree planted, a kilo of plastic recovered, or a piece of coral reef restored. Join the hundreds of companies that are already boosting sales and retention while making an impact. Go to impacthero.com/podcast now to get 10% off. Again, that's impacthero.com/podcast to get 10% off.
Welcome to another ClimateTech podcast, interviews with the people trying to save us from ourselves. Kittu Kolluri is the founder and managing director of Neotribe Ventures and one of the 100 most influential investors, according to the New York Times. You might not know his name, but you definitely know one of his products. He's the founder of WebMD. Kittu is investing in some serious deep tech, looking at areas like hydrogen generation, ammonia synthesis, and cold fusion. I reached him in Menlo Park, California. Please take a moment while you're listening to this episode to rate and subscribe to the podcast. It's really the number one way people find it. I'm Ryan Grant Little. Thanks for being here. Kittu, welcome to the podcast.
Thank you, Ryan. Thanks for having me.
You are the co-founder of WebMD, as well as a seasoned VC. And in fact, the New York Times called you one of the top 100. So you're really Silicon Valley royalty. And these days, the main hat that you wear is as the founder of Neotribe Ventures, which, as you say on the homepage, invests in breakthrough technologies that stretch the imagination. Can you talk a bit about the fund and how it's evolved over the past 7 years since you founded it?
Yeah, in terms of the thesis with which we started the firm, that hasn't changed a whole lot, Ryan. When we say we invest in breakthrough technologies that stretch the imagination, we like to invest in companies that are solving hard problems, hard technology problems, but are also kind of looking around the corner, reimagining the world and creating new product categories. And so about 2/3 of our capital goes into companies in the software space, up and down sort of the enterprise stack, insurtech, fintech, a little bit on the Web3, more on the infrastructure side. And then the rest goes into companies at the intersection of bits and atoms, as I like to describe it. So these are companies that are leveraging AI and computer science, data science, etc., to innovate in life sciences, climate tech, robotics, 3D printing, things like that. So that's kind of what we invest in. And in terms of how it's evolved, there are certain sectors that come in and out of fashion at any given time. And so depending on what's more in vogue, we probably tend to invest a little more in that, but it kind of evens out over a longer period of time.
And I feel like a lot of VCs who have been investing previously in the software or SaaS space over the past kind of 10 or 15 years, a lot of them are trying to shift more into hardware. And I know that you're bullish on hardware. You're not afraid to kind of jump into that space. And I'd be really interested in getting kind of your view on that. We'll come back to that in a moment. I'm interested. So 2/3 I'm interested maybe in the other 1/3 as well. So you've invested a lot in deep tech, but you've also invested a lot in climate, and you've been in climate for a long time. So I'm thinking of your 2001 investment in, I forget what it was called before, but Bloom Energy. I remember them.
It used to be called Ion America when I first invested in it.
Yeah, I remember them. I mean, when I was in renewable energy in the mid-noughts, and they were a big deal back then. So I was, a founder in the space between 2006 and 2010. And I'd be curious to kind of know, so, most of the people who I talk to or have invested in the space or have been in the space haven't written the first check 23 years ago. And I wonder kind of how your view on investing in climate tech has changed, evolved, stayed the same since then.
Yeah, great question. So as you mentioned, my foray into climate tech and investing in climate tech started in 2001 when I first made a personal investment in a company called Ion America, which is now known as Bloom Energy. Just to give you a little bit of my background, I'm a mechanical engineer by training and then kind of moved into computer science. And so I have this interesting combination from an educational background point of view. And truth be told, some of that was just accidental. But in hindsight, that combination has helped me a great deal in not only understanding some of the technologies behind climate tech, but in better underwriting them as well. As you know, a lot of climate tech involves material science, chemistry, thermodynamics, things like that. And those are fields that I had some exposure to from my undergrad days. And I think those were helpful. But if you ask me how my view on climate tech has changed over a period of time, I think back when I was first starting to invest and when I joined NEA as a general partner, a lot of the climate tech investing that I did then revolved essentially around material science. It was around, how do you find better materials to capture energy out of sunlight or things like that, so photosynthesis and things like that, or photovoltaic rather. But what happened over a period of time is, silicon became very cheap. And so you didn't get paid a whole lot for innovating on the material side. And I'd say where my investment thesis has evolved is sort of at this intersection of bits and atoms that I talked about earlier. It's about taking information technology and seeing how that could impact some of the more traditional fields like material science, like chemistry, and things like that.
What kind of convergence are you seeing also? I mean, I'm wondering if you've been investing a lot in the kind of medtech space or kind of biotech space. Do you see a convergence there with some of the climate tech space as well? I mean, as you kind of point out, you mentioned, if 10 years ago, most climate tech investment was on the energy production side, do you feel like there's more of a convergence between these two spaces now as someone who looks at both of these spaces as an investor?
Yeah, I think great question again. I do think there is some convergence, more to it than meets the eye. Like, for instance, I'll give you an example of, a microbiome related innovation and how that can be used to break down wastewater. That's something that's been done for a while. But also, how can you use microbes to synthesize ethanol? And this is something that's actually today it's more sort of, I'd say, in the scientific domain in the universities, but I wouldn't be surprised if that starts to become much more mainstream and gets commercialized in due course. So that's an example, but sort of the application of microbiomes in the food and agri-tech space, but also in the area of synthesizing clean energy in some shape or form. That's something that, how do you store electricity using microbiomes from electricity that exists, sort of clean energy, and how do you convert that into alcohol? That's something that, by the way, at the bottom of the ocean, that's something that bacteria have done. And now that's starting to be researched heavily. And people are looking into how can you take clean energy produced from sunlight or wind or ocean and store that using microbiomes. So that's something that's an interesting area.
I feel like I have lots of episodes these days about energy storage and different ways of doing that on the podcast now. And it feels like where 15 years ago we were trying to unlock the best ways to produce the energy, now we're trying to unlock the best ways to store it. That's probably a good sign.
That's because clean energy is intermittent.
Exactly.
So we need to find effective ways of storing energy.
Yeah. So you invest where bits meet atoms, and that's a soundbite I've come across in some of your interviews before, and I find it really interesting. Another one is AI trumps physics. I've heard you say that a few times. Can you talk about that? I've got a suspicion about what that means, but enlighten us.
Yeah, so there have been a lot of climate tech related innovations that have centered around trying to model physics and trying to see if you can somehow mathematically predict something. Or I'll give you an example, right? Take one of our investments, Heliogen, from our fund one. It innovated in the closed loop solar concentration space. So if you think about solar concentration, there has been for several decades innovation in what I like to call open loop solar concentration, where people have said, okay, let me model how the sun moves in across the horizon, and doing that using physics and mathematics. However, as you know, there's a lot of error creep in computers because computers always have a rounding error. And so over a period of time, that error creep results in a diffusion of that energy. And so very quickly, that solar concentration doesn't work or doesn't produce the kind of temperatures you need. This is where Heliogen innovated and said, okay, we don't care what physics says. We're going to put 4 cameras and look at the reflection of the sun. And from that, we can tell if the sun is pointing towards the reactor or not. And if any one of those 4 cameras can see the sun, reflection of the sun, they adjust it. If none of them can see the reflection of the sun, boom, it's pointing at the center of the reactor. And so that resulted in an incredibly high amount of accuracy without a whole lot of computation. And so that is what I mean by how AI trumps physics. So the interesting thing that I've seen across a wide variety of spaces is that if there is an underlying pattern, AI does a fantastic job of unearthing that pattern. And that's where I feel like, it behooves us to use AI. I mean, we have an investment in another company called IRA that's in the wireless communication space. And it's done the same thing. A lot of people try to model wireless communication, again, using physics, but IRA has used machine learning to figure out what the signal to noise ratio is on a particular channel. And so that's another example of where I feel AI has trumped physics. So that's what I mean by that. I hope that those 2 examples kind of give you some sense.
I think "we don't care what physics says" should also be a new saying of yours, or maybe a bumper sticker that love that.
Provided there is a pattern.
Makes a lot of sense. And I mean, those examples also sound like...
If it's purely random, AI doesn't do shit.
Yeah. Yeah, but I mean, very few things are totally random anyway, right? So
exactly.
If the data set's big enough, it will find the patterns, and that's where the magic happens. I mean, those are good examples also of some pretty great hardware interventions. And as I mentioned, so, I feel like a lot of VCs that made a lot of money kind of investing in the next new B2B SaaS play decided that they can be ClimateTech investors overnight as well. And I've been involved in some deals recently where they kind of, caused the deal to fall apart. Well, I mean, one deal in particular. And you could clearly see that it was because it was a company that knew SaaS really well and just totally fell on its face when it came to trying to understand kind of the horizons and the complexity around hardware and some of these more complex things. And I wonder, because there are a lot of ClimateTech VCs that are listening out there, or people who want to get involved in ClimateTech, what advice would you have? And I think you mentioned kind of one of the first pieces of advice is to kind of like have, in your case, you have the basics yourself, but maybe it's about having, someone with the subject matter knowledge in the team.
Yeah. I mean, I'd say first go back and dust your chemistry, material science, thermodynamics books so that you can catch up on that. Because, when you're investing in SaaS, you probably don't even need a whole lot of technical expertise. You're really investing around business models and things like that, right? And it's really much more at the application layer. When you're investing in ClimateTech, you actually need to grok something at a much more fundamental level and much more at a fundamental science level. All right. And that's where the differentiation comes from. And so you need to have a certain amount of knowledge at that layer. And so I like to call it this, right? In the VC world, if you don't know what you don't know, that's very dangerous, because with that comes a lot of hubris. And hubris is the biggest enemy of making money. I advise a lot of young VCs who I mentor, and I tell them, your goal ought to be to know what you don't know. And so if you know what you don't know, one, what questions to ask, two, who to ask them of, and three, how to underwrite the risk you're taking. And so that's what I would say to any SaaS VC coming into climate tech, start with trying to know what you don't know.
I work with a lot of companies who plan to open up shop in or expand across Europe. My one big piece of advice: don't fall into the trap of setting up a new entity right away. Instead, talk to my friends at Paracar, who can help you get up and running without all the costs, not to mention the legal and HR hassle. When I was hiring in different EU countries, I wanted my team to focus on their work, not on the country's bureaucracy. After interviewing a half dozen international expansion firms, I chose Paracar because they were by far the most knowledgeable and they're great people. Whether you're a large multinational looking to expand abroad, a small business looking for the right talent, or a contractor, they'll sort it out. Book a free, no-obligation consultation right now at paracar.eu/climate. That's PARAKAR.eu/climate. Yeah, I think that's really good advice. And I mean, also with some of the SaaS investments, everybody was used to just kind of making so much money from this that develops the hubris that you can't get it wrong. And we've definitely seen.
How hard could this be?
Yeah.
A lot of people would come back. How hard could this be?
Yeah.
And the thing about investing in climate tech is, there is a hardware component, and that brings a certain level of complexity. There are business model differences also. Do you go with selling a product, or do you do an owned and operated kind of thing, which is kind of similar to SaaS, but the difference there is that there is a working capital issue. There's a CapEx involvement, right? And is there a way that you can attract cheap capital? And, those are the sorts of things that you need to think about and worry about, as opposed to, using a cloud service provider to host your application and getting things off the ground.
I mean, you're touching on financing, which I think is really key to this as well from the hardware perspective. And it's a conversation I have a lot with the founders, because you get a lot of founders who have, decent business sense, very, very strong on the science side, but, maybe haven't built a $10 million pilot plant before. And, I had one conversation not too long ago where I said, look, you're trying to build this whole plant with equity, which is too expensive. And by the way, the plant costs more than the company is worth in this round. You're like, oh, yeah. So that's, these kinds of challenges. And I think, my experience also going back to the biogas days is so much of it was about putting together and like kind of stacking this financing. And that's a really, really complex piece. So I feel like for some of these companies, for some of these startups that are very hardware heavy, they probably aren't thinking about it, but their CFO or whoever their kind of finance person needs to be really, really strong in a way that maybe a SaaS company doesn't need to be.
Yeah. And one of the pieces of advice that I give a lot of climate tech companies is this, which is separate out the technology piece of your innovation from the project engineering part of your company. And what I mean by that is, in fact, you may be better off creating two companies, right? The technology company and the actual, solutions company, because the technology company can attract venture capital, and that's, high cost capital. Your cost of ownership there is much higher because your cost of capital is much higher. Venture capital is not cheap, all right? But when you start to scale up, that's where you should be able to attract cheaper capital, but you need a lot of capital there, right? And you don't want to drown out your venture investors with a lot of this cheap project capital, right? And so that's why I advise them to split those things into two separate companies almost, where now this technology company is licensing that technology to this project company.
That's really, really good advice. That's a path that I've followed as well. And it also protects the IP from going under from a project that goes astray. And projects can go astray very easily for reasons that have nothing to do with the great IP.
Yeah, 100%.
Do you want to talk a bit about some of the deals that you've made, specifically, kind of climate or climate adjacent? I'd love to hear about some of these investments and why they made it past the investment committee.
Yeah. So there are certain areas, I'm not going to pick on specific deals, but certain areas that have recently captured my imagination, Ryan. I'm a big believer in the hydrogen economy. I don't think hydrogen is going to be used to power vehicles, but I think hydrogen is going to be a very important part of our clean tech economy in terms of taking clean energy and converting that into hydrogen, and then converting the hydrogen into ammonia to transport it better, because transporting hydrogen is problematic. And so the hydrogen ammonia innovation in those areas are areas that are very interesting to me. Whether that be taking methane and doing pyrolysis of methane, but doing so in an easy way and a clean way, and doing so where you're able to generate crystalline carbon as opposed to carbon black, right? There are technologies today that can do methane pyrolysis, but they're generating carbon black. And, now you're just trying to sell hydrogen. However, if you're able to generate graphite or graphene, now that becomes very interesting, because now that more than pays for the generation of hydrogen, right? In fact, that could become the main product in itself, right? So that's one area that I'm pretty excited about and looking for opportunities there. Another area that I like a lot is this ammonia synthesis area. We haven't seen a significant innovation in ammonia synthesis since Haber-Bosch, and as we all know, Haber-Bosch is pretty pollutive and carbon pollutive technology. So we need another innovation there where we can synthesize ammonia in a clean way, because ammonia, as you know, is not a naturally occurring substance. It is something that is synthesized, but we need better ways of synthesizing that substance or that material so that we can use that to transport hydrogen, as I mentioned. And ammonia, as you know, has a variety of uses for fertilizer, for various sorts of creating inert atmospheres and things like that. And so sometimes synthesizing ammonia at the point of need is actually a very important thing. And so that's another area that I'm excited about. A third area is cold fusion, nuclear fusion at low temperatures. That is still, I'd say, at a science risk stage, but not for long. I think it's a matter of when and not if we crack the code on nuclear fusion. So these are three areas that I'm pretty excited about.
I'm going to send you some links to some past episodes because they'll be very interesting for you and they could be investment targets. So I'll send you that after we get off here.
And if any of your listeners are doing things in these areas, I'd love to hear about it.
Yeah, great. Great. So science risk, that's the one risk that you don't want to take. Is that correct?
I'd say, we generally shy away from it, although there are exceptions there. Like, for instance, we've invested in a company called Aquarius Energy in that cold fusion space. And I'd say that's one, there is some science risk. But the reason I did that is like, man, if that company can crack the code on that, boy, that could be a huge company.
Yeah. Okay. So the serious moonshot potential ones, you're willing to dip into the science risk as well.
Correct.
Yeah.
Correct. I'm unlikely to write a large check into those companies, but enough to get them past that science risk stage.
Yeah, I mean, they probably couldn't efficiently use a large check. A lot of them are at this point, right?
100%. You're absolutely right.
So I was astounded. I counted the number of boards that you've been on or are on right now, 53. And that includes some pretty big names like Robinhood, the investment platform, and Box, which was one of the original cloud collaboration companies. I remember using them, 15 years ago. And I'm sure I've never met anyone who's been on this many boards. And boards is a topic that I'm really interested in. My only unicorn was a nonprofit, so not a unicorn in the cash out sense, that I founded called Canada Helps, which processed more than $3 billion for Canadian charities so far. And it's been around for 25 years. I founded it when I was 19. And I think one of the reasons it's done so well and it's never had any kind of controversy or even kind of whiff of it is that right from the beginning, we built a really, really strong board that was representative of the beneficiaries that we serve. So like the customers and kind of, for-profit speak. And we really made sure that it wasn't our people, and not kind of just a circle of friends, but really qualified people who would hold us to a really high standard. And that tradition has kept through with that board. And for me, it's one of the most successful boards, full stop. And so I'm always thinking about this. And a lot of times as an investor or just I see companies, Europe, I think is even much worse than North America or kind of the common law countries, the Anglo-Saxon countries with this, where there's lots of kind of double dipping and, the managers are the board and maybe kind of they add a friend over time and stuff like that. And you can really see where this causes problems. And so, but what I'd love to hear from you is, as someone who has this massive, massive experience, what is the thing or what are the features that the best boards have in common in your experience?
Yeah. Before I answer that question, I wanted to say that, I've been in probably even more than 53 boards because I've probably not yet put all of my boards on there.
I mean, maybe you just run out of fields in LinkedIn at a certain point or something.
No. It's not that. I have to go back and see because I think between my tenure at NEA and now here at Neotribe, I've been in venture for, over 18 years. And I think I've been associated with over 100 companies that are, what I'd call full slot investments for us, right? And not just, sort of small checks, not a pre-seed kind of checks. And that said, it's been over those 18 years. And so in my defense, it's not like I get on too many boards, although that's a sensitive topic for some of our LPs. But coming back to your question, I think boards are very important from a governance point of view and from a steering point of view. And I take my role as a board director very seriously. And I think what a lot of board members do wrong is this. When you are on a board, you have a fiduciary responsibility to ensure that you're taking care of the interests of all shareholders, not just the entity that you represent on that board.
I'm getting goosebumps. It's such a refreshing point of view.
And I think that is one of the big mistakes that a lot of board directors make is they're looking at their role there and their decision making or their advice or commentary purely through the narrow lens of how does this benefit my firm? Or even for that matter, if you look at it from the perspective of the founders, they're making the same mistake also. They're looking at it as how do I ensure my interests are taken care of? And I think you need to come at it as saying, how do I take care of all stakeholders here? How do I take care of common shareholders, preferred shareholders, my customers, and the community? All of them. You got to put your hat on to ensure that you're doing the right thing by all of them. Otherwise, you're violating your fiduciary responsibility, right? Second thing that I'd say is boards are teams. Just like management teams are teams, boards are teams. And so boards need to figure out how they can coexist and work together. How do they divide and conquer? Right? There's a division of labor there. And in getting along with one another there is really important at a professional level. And that's another thing that I feel is sometimes lacking in certain boards where there is too much posturing and too much, I say, people are pretending to be somebody they're not. They're seeking to impress rather than express, right? And so those are times when boards get into trouble. And so these are the two things that I'd say if you are able to avoid. And that's why I like to ensure that there is representation of independent board members once a company gets to a certain scale where, they're not representing common or preferred. They're actually looking out for the company.
That's a really, really refreshing perspective. And it's something I've talked about before as well, that there's almost an inherent conflict of interest for a VC to be on a board, right? Because the VC, well, they have the fiduciary responsibility to the company, but they're always prioritizing kind of their portfolio, right, and their fund. And I've seen how that can play out. As you know, I founded a company that was the last investment of a VC before the financial crisis. And the tone changed very drastically as they kind of lost commitments from LPs and had to then shift to rescue the companies that they're in deeper with. And literally overnight, you could feel this conversation of like planning for success is more like, why are we burning so much money pre-revenue? And you're like, hold on. And this is purely because, they're looking at this from a portfolio perspective at their own portfolio, which has, it's a built-in conflict of interest.
100%. And so, my counsel is, if you cannot fulfill your fiduciary responsibility, get the hell off the board. If all you want to do is represent your entity as a shareholder, as a stockholder, fine. Do that as a non-board member, as a shareholder. Then you can vote your shares. That's well within your right to do so. And there are a lot of things that require shareholder votes, right? And so that's the right thing to do.
That's good advice. As an investor, do you generally like to, I know you like personally to take board seats, but as an investor, do you like to take board seats? Is it a requirement? Are there certain things that you need to see in the boards of the companies you invest in order to get, that check written?
We don't require a board seat all the time. It depends on our check size, our ownership, and things like that. And also, what is the value we could bring to the company, right? Based on our experience. And so those are the factors that result in us determining whether we take a board seat or not. And sometimes the entrepreneur says, hey, we'd like you on our board, right? And so that's when we consider taking a board seat.
Yeah, that makes a lot of sense.
But generally speaking, we are active investors, Ryan. And so we think having a board presence is helpful. Especially, I find that a lot of young entrepreneurs, first-time entrepreneurs, they don't know much about governance, right? And that's where we kind of help them with that by having a presence on the board.
What does it mean from your perspective to be an active investor?
Very simple. It's about helping the entrepreneur discover product market fit. And that can manifest itself in a variety of ways, which is, helping them figuring out what are the use cases that create that, damn, I cannot not have this product. Helping them with recruiting management talent to the company, helping them with customers, helping them with potential partners, and eventually helping them with potential buyers. So these are all the things that we like to help our companies with.
Just kind of crystal ball gazing now. So I know the topics that you're interested in. You're talking about cold fusion, hydrogen, things like that. Going to kind of a more macro level about maybe the investment ecosystem. What do you think? It's been a hard few years for most hardware VCs or investees, and particularly anything that's not AI in the past couple of years. What do you think? And actually, AI is getting beat up a little bit right now on the markets. We're seeing that. So a bit of backlash happening there. But, if you were to look out the next couple of years and recognizing that prediction is a fool's game in some ways, but, what trends would you not be surprised to see? Let's put it that way.
Look, I think if you are in any kind of hardware business, even if you look at just pure information technology, there are a lot of businesses that have a hardware component. Like if you're building a router or a switch, or if you're building a security appliance, there is a hardware component. My second company was a security appliance. And so we did have a hardware component there too. But what happens is that as interest rates go up, your cost of capital increases. And so therefore, hardware becomes more expensive. And so you need to figure out how to help finance that. And so that's one of the things that I'm hoping that, we get to a quiescent period here in terms of interest rates. I don't think it was ever sustainable to have zero interest rate environment like we enjoyed for the last 30 plus years. It's actually not good for the baby boomers because they're relying on interest income as they retire. And so, interest rates in that 4 or 5% range, I think is normal. and it's probably healthy. And that's kind of where we seem to be landing here. And so I'd say we will have that as something that we need to think through. Another advice I'd give is to any entrepreneurs is, talking about this bits meets atoms, try to figure out how you can improve your offering, your product offering with data, right? And applying something like artificial intelligence. So there are a lot of old economies, companies or sectors, industry structures that have benefited immensely. Like I'll give you the example of computational biology or bioinformatics, right? It is amazing to me what the availability of data and the application of artificial intelligence and machine learning and things like that, those techniques to that data have done to the field of diagnostics, drug discovery, vaccine discovery, medical devices, things like that. And we're just scratching the surface, Ryan, in that area. I mean, just take the mRNA vaccine. That was as much of a software problem that was solved as it was discovering the right kind of RNA sequence to help fight the COVID virus. So I think you're going to see that in the coming years. One of our companies, Billion to One, has done the same thing in the diagnostics area, where they've applied machine learning to cell-free DNA in the host blood for both prenatal testing for single gene diseases as well as oncology. So I think there is a huge amount of opportunity there. And so that's one of the things that I encourage a lot of entrepreneurs to do, is to see, hey, fine, I've got my innovation purely from a materials point of view, but with data available, can I improve on that in a significant way? Is there a tectonic shift that is possible?
I think that's a great place to end this conversation, because it's on a positive note and it's looking forward to kind of how AI can support a lot of these things, especially on the health tech and climate tech side. I'm also very bullish on that. I've seen some great progress. I mean, I invest a lot in food tech, and some of the opportunities to use AI, for example, BioCraft Pet Nutrition, a company that I'm invested in that makes cultivated meat for pet food, was able to use AI to determine really the best, perfect kind of strains of rabbit meat, for example, for pets, and mouse meat for rabbit meat for dogs and mouse meat for cats. And this would have taken centuries to do using kind of more traditional computing methods.
Medicinal chemistry kind of approaches. Yeah,
exactly. And as a pet parent who would love to be able to feed my pets meat, but not from animals one day, these are the kinds of innovations that I think we'll be seeing more of. And we need them, right? I mean, we can't keep going with business as usual.
100%.
Yeah. Kittu, I will put a link to your LinkedIn in the show notes and encourage. So any startups out there that are fundraising, that are working across the 3 topics or so that you mentioned, might like to reach out. Kittu, it's been such a pleasure talking to you. Thank you so much.
Thank you, Ryan. Thanks for having me. And I hope your listeners find this useful.
Brilliant. Thanks for listening to another ClimateTech podcast. It would mean a lot if you would subscribe, rate, and share this podcast. Get in touch anytime with tips and guest recommendations at hello@climatetechpod.com. Find me, Ryan Grant Little, on LinkedIn. I'll be back with another episode next week. Bye for now. This episode is supported by Grizzle, B2B content to create and capture demand. I first met Grizzle's founder, Tom Watley, 5 years ago at a conference in Dublin. I was so impressed that I signed a deal with him to do all my software company's content that same evening at the pub. Remember that, Tom?
Kinda.
And they're still doing it 2 years after we sold the company, because the new owners love Grizzle as much as I do. If you sell B2B, book 30 minutes in Tom's calendar at grizzle.io/climate. That's GRIZZLE.io/climate.